Two people walked into the same bank on a Tuesday morning. The first was 29 years old. She had $180 in her checking account, a credit card balance she'd been carrying since March, and an overdraft from the previous week she was still hoping to sort out. The second was 34. He had $20,000 sitting in savings, no credit card balance, and a car he'd paid off 2 years ago. Now, if you had to guess which of those two customers the bank actually wants, you'd say the second one. Obviously. He's got money, he's responsible, he's exactly the kind of person a bank should be fighting over. He's not. He's the problem. The woman with $180 and the overdraft will generate more revenue for that bank this year than the man with $20,000 in savings. Not slightly more, multiples more, and once you understand why, you will never look at a bank branch the same way again. Because there is a number attached to your name inside that institution that you will never see, never be told about, and never be allowed to request. It isn't your credit score. Your credit score measures how likely you are to pay them back. This other number measures something completely different. It measures how much money you are worth to them. And $20,000 in savings is roughly the point where that number goes negative. Let's start with how a bank actually makes money, because almost everyone gets this wrong. Most people picture it something like this. You deposit money. The bank lends it out. The bank charges more interest than it pays you and keeps the difference. And that's true. That's called the net interest margin. And across US banks, it runs at around 3%. It's the main engine. But here's what that picture leaves out. The spread only works if two conditions hold. Your money has to stay put, and it has to stay cheap. The FDIC reports the national average savings account pays 0.38%. Your deposit costs the bank about 1/3% a year. They turn around and lend that same dollar back out as a car loan at 7%, a mortgage at 6.5%, a personal loan at 12%. The gap between what they pay you and what they charge the borrower is the business. That's it. That's the whole model. So on paper, a customer with $20,000 in deposits should be excellent. That's $20,000 of funding at 1/3%. That's cheap fuel. Except there's a second engine, and it's the one nobody mentions at the branch. Fee income. In 2019, American banks collected roughly $12.6 billion in overdraft and non-sufficient funds fees. $12.6 billion in 1 year from one category of fee. That isn't interest. That isn't lending. That's people who ran out of money at the wrong moment, charged somewhere between $26 and $35 for the privilege. And here's what makes it remarkable. That revenue is concentrated. The Consumer Financial Protection Bureau has found repeatedly that a small share of account holders generate the overwhelming majority of overdraft fees. People who overdraft 10, 12, 20 times a year. The customer who is chronically short by $40 is not a bad customer. In that revenue line, they are the entire business. Now, run the man with $20,000 through that engine. He cannot overdraft, not because he's disciplined, because it is arithmetically impossible. His cushion is larger than his monthly expenses. When his car insurance auto-drafts on the same day as his mortgage and the timing goes sideways, nothing happens. No fee, no alert, no $35. He has removed himself from a $12 billion revenue pool permanently by accident. And that's just the first engine. The second one is worse for them, and this is where it gets genuinely interesting, because the credit card industry has a word for people like him. 2 words, actually. And they're both real. If you carry a balance month to month, the industry calls you a revolver. If you pay in full every single month and never pay a cent of interest, you're a transactor. And in the older, blunter version of that vocabulary, the version people in the business used for decades, the full payer had a different name, a deadbeat. Sit with that for a second. In the language of the industry, the person who pays the bill on time and in full is the deadbeat. The person who can't is the customer. There's a reason. Americans are carrying more than $1.2 trillion in credit card balances, and the average rate on those balances runs above 21%. That is the most profitable consumer lending product in modern finance. Nothing else is close. A $6,000 balance at 21% generates about $1,260 a year in interest from one person on money that has already been spent on things that in most cases no longer exist. The man with $20,000 in savings uses his card. He probably uses it constantly for the points, and he pays it off in full every month, which means the bank earns the interchange fee from the merchant, roughly 1.5% to 2%, and absolutely nothing else. He collects the rewards. they collect the crumbs. He isn't a customer at that point. He's a rounding error with a travel balance. Now let's talk about why the number is $20,000 specifically, because this is the part that actually matters, and it has nothing to do with $20,000 being impressive. $20,000 is roughly where the math stops being theoretical. Take someone with $2,000 in savings. At the national average of 0.38%, that account earns $7.60 a year. Move the same $2,000 to a high-yield savings account paying 4.20%, and it earns $84. The difference is about $76 a year, $6 a month. Now, $6 a month is real money, and they should absolutely go get it. But be honest with yourself, nobody restructures their financial life over $6 a month. The friction of opening the account is larger than the reward, so the money stays exactly where it is. Which is the point. Now take $20,000. At 0.38%, it earns $76 a year. At 4.20%, it earns $840. Sitting in 3-month treasury bills at 3.71%, it earns $742, and that interest is exempt from state income tax. The difference is $764 a year. That's a flight. That's a month of groceries. That's a car repair you never have to think about. And at that number, something switches on in a person's head. They run the math once and they never unsee it. They realize they have been lending the bank $20,000 at 0.33%, while the bank lends it straight back out at 7%. And nobody at that branch ever brought it up. Not because anyone lied to them, but because it is nobody's job to bring it up. So they move the money, and the second they do, they stop it being a deposit and become something the industry has a specific name for: hot money. Banks track this obsessively. There's a metric called deposit beta, which measures how much of a Federal Reserve rate increase a bank actually passes through to its own depositors. When the Fed raised rates from near zero to over 4% in 9 months in 2022, the largest U.S. banks passed through only a small fraction of that to ordinary savings accounts. Their deposit beta was low. That was a choice, and it was worth billions. But that choice only works on sticky deposits. Money that doesn't move when rates change. Money belonging to people who either don't notice or don't have enough for it to matter if they did. Someone with $20,000 who has run the calculation is the opposite of sticky. They are rate sensitive. They will move the entire balance over 3.8 percentage points, and they will do it from their phone in about 11 minutes without ever speaking to a human being. And banks know exactly how fast that can happen because they have watched it happen. In March 2023, Silicon Valley Bank lost $42 billion in deposits in a single day. One day. Not a run on the branch with people lining the sidewalk. A run conducted entirely by app and wire transfer. By depositors who did the math and left. The bank did not survive the week, and the mechanism wasn't fraud. It was that the funding walked out the door. That was corporate money at enormous scale. But the psychology is identical, and so is the fear. Deposits are the cheapest funding a bank has, and the entire model assumes that funding sits still. A depositor who has proven they will move money for yield is a depositor the institution has to actually compete for, and competing costs them the margin. That is the difference between a customer and a counterparty. That's the second reason. There's a third, and it has nothing to do with the bank's balance sheet at all. $20,000 in savings changes what you are able to refuse. Think about what a cushion actually buys you, not comfort, leverage. You're sitting in a dealership finance office, and the manager slides the extended warranty across the desk. It's $2,400. The profit built into that product is somewhere between $700 and $1,000. If you have no cushion, that warranty doesn't feel like an upsell. It feels like protection, because if the transmission goes at month 14, you genuinely cannot pay for it. So you buy it out of fear, and the fear is completely legitimate. If you have $20,000, you are your own warranty. You look at it, you say no, and you mean it, because you can absorb a $2,000 repair without flinching. Same story with your insurance deductible. Moving from a $500 deductible to a $2,000 deductible lowers your premium every year for as long as you own the policy. But only a person with cash can take that trade safely. Same story with the payday lending industry, which operates at annual rates that routinely run past 300 and 400% and exists for one reason. Millions of people cannot absorb a $400 shock. The Federal Reserve's own household survey has found for years that roughly a third of American adults could not cover a $400 emergency expense with cash on hand. For that industry, that isn't a market failure. That is the market. Same story with your job, and this is the one that never shows up on a spreadsheet. A person with 3 months of expenses in the bank negotiates differently, waits for the better offer differently, leaves differently. Desperation gets priced into every transaction you enter, and everyone sitting on the other side of the table can smell it on you. So a person with $20,000 saved is a person who says no. No to the add-on. No to the upsell. No to 24% financing on a couch. No to the first offer, and no to the second one. Every industry built on consumer urgency quietly loses a customer the day that account crosses a certain line. Now, I want to be careful here because this isn't a conspiracy. There is no room where they discuss you by name. It's simpler than that and honestly more unsettling. It's incentives. Nobody at your branch is lying to you. But look at what the structure does. The savings account that opens automatically alongside your checking account is the one paying 0.38%. The higher yield option usually exists, but it's a separate product, on a different page. Sometimes at a different institution the same bank happens to own. Transfers out to an external account take 1 to 3 business days. Transfers in are instant. Minimum balance requirements keep a floor of your money parked in a low-yield account to avoid a monthly maintenance fee, which means you are paying a fee for the privilege of being underpaid on your own money. And when you do walk in with $20,000 and ask what you should do with it, you will be offered products the bank sells. A certificate of deposit, a bundled savings tier, maybe a meeting with an advisor. What you will almost never hear is, honestly, put it in 3-month treasury bills. You'll earn more and it's exempt from state tax. Nobody is required to say that. Nobody is compensated for saying it. The system isn't rigged against you. It's built to profit from your inattention. And it works perfectly well without a single person acting in bad faith. So what do you actually do with all of this? First, find out what your savings account is paying right now, not what you assume it pays. Log in and look at the real number. Most people are genuinely shocked, and the shock is the useful part. Second, split the job in 2. Your bank is for transactions, direct deposit, bill pay, the branch you can physically walk into. It does not have to be where your savings live. Keep 1 to 2 months of expenses in checking and move the rest somewhere it earns. The accounts talk to each other. There is no penalty for this. Third, understand your options at the level of 1 sentence each. A high-yield savings account is FDIC insured up to $250,000 per institution and currently pays around 4.20%. A 3-month Treasury bill is backed by the U.S. Treasury, pays about 3.71%, and the interest is exempt from state income tax. Both are as safe as the money sitting in your branch account right now. The only thing that changes is which institution is holding it. Fourth, run your own number instead of mine. Take your actual balance, multiply it by 0.0038, then multiply it by 0.042. The gap between those two numbers is what your inattention costs you every year. Write it on a piece of paper. It is the most persuasive financial document you will ever produce. Fifth, and this is the one that compounds, protect what the cushion is actually for. The $20,000 is not an investment. It isn't supposed to grow aggressively. Its job is to make you unbuyable. It's the thing that lets you decline the warranty, take the higher deductible, walk out of the dealership, wait out the bad job, ignore the 400% loan. That's the return. It just never shows up on a statement. So let's go back to that Tuesday morning. The woman with $180 and the overdraft is not irresponsible and she is not stupid. She is expensive to be, which is the cruelest arrangement in all of consumer finance. The less you have, the more everything costs. Overdraft fees, balance minimums, higher insurance premiums, worse loan rates, and the extended warranty you have to buy because you can't absorb the repair. And the man with $20,000 didn't beat anybody, he didn't find a loophole or a trick. He accumulated enough of a buffer that the entire apparatus built around consumer urgency simply stopped working on him. That's the whole thing. Banks don't fear you at $20,000 because you're rich. $20,000 is not rich, and anyone who tells you otherwise is selling something. They lose interest in you because at $20,000 you stop being profitable. You stop paying the fees. You stop carrying the balance. You start noticing the rate. And you gain the ability to say no. Somewhere between $0 and $20,000, there is a line where you stop being the product and start being a competitor for your own money. Most people never find out where that line sits, because nobody whose income depends on it is ever going to point at it for you. You just did. If you've ever checked your savings rate and felt that very specific kind of annoyance, tell me in the comments what your bank is actually paying you. I read them, and the range is always wider than people expect. And if you want more of the math nobody explains out loud, subscribe to Mark Invests. Your money is either working for you or it's working for somebody else.